So, hello everybody. My name is Jean Rognetta. I'm the president of PME Finance, and I am very honored to host this webinar on advantages and disadvantages of stock markets for European tech companies. Just two quick notices. This webinar will be recorded and published on the internet, and if you want to put any questions, please do so through the Q&A interface of Zoom. I will take all written questions at the end. Very quickly about me. I'm a journalist and president of a professional association called PME Finance. And what we did was interview CEOs and CFOs of 6 listed companies, all with a tech component, one from biotech, one from telecoms, 3 software vendors, all of various with different specialties, and one that does electronics. The question was always the same: how do you manage your valuation, and what strategies what do you do actually to make your valuation as solid and good as possible? Now, and is it a valuation or a liquidity problem? If we look on the aggregate, well, the money is there, and Euronext, which is the market, all companies are listed on Euronext Paris, either on Euronext Growth, on Euronext main listing, and they are part of the Euronext Tech Index, which after plunging in 2018 and 2016, has rather well recovered. It weighs now 41.3 billion, now being the end of 2019, according to Morningstar. This puts it right in the middle of the 30 billion to 50 billion total capitalization, on which it has been for the last 6 years actually. So it's far from its peak, and that puts it apart from the global markets, as large caps are well past their peak. So we could say that although small and mid caps haven't rebounded as strongly as large caps and are still far from their peak, they are growing, and they still have room to grow, as we shall see. We have foreign investment funds on the prowl for these companies, and the aggregate figures are rather not bad, though not as good, though there is definitely a size premium. The larger the company, the better the result and the valuation. If we go into detail, IT has been the main component of this rebound. Valuations, capitalization, sorry, have increased of almost 14%, for 14% in healthcare, and only 11% in industry. And multiples remain depressed, not as depressed as they were in 2018, when they reached 65% of fair value, but they have rebounded only to 78% of fair value, whereas at the height of 2017, they were beyond 100%. Morningstar attributes the rebound, which of course goes with the rebound in capitalization, to central bank policy of putting a lot of money in the market and therefore forcing investors to look for risk and return. And though this is certainly a factor, the truth is that in general, the small and mid tech caps on Euronext specifically remain very cheap. And this is true of most European markets from what I hear. And this creates a valuation problem. I have taken the case of Esker. Esker is a software vendor based in Lyons, which with subsidiaries in the United States. It's listed on Euronext Growth, and its revenues have capped 110 million euros for a market cap of more than 600 million. So it's a very good multiple, 6 times revenues and 55 times the net income is a very good revenue for very good multiples for a software vendor in France. But if we look to its next comparable in America, then we get turnover that is not so different. It's okay, 3 times bigger, but market capitalization is 11 billion. Therefore, we are on multiples that are on turnover 30 times as better for Coupa. And of course, price equity ratio cannot be calculated because Coupa is not profitable. And all the money it gets goes into growth. The analysis from Esker is that the American market values proof of business model over immediate profitability, and that is how you create a world market leader. So what they have been doing is to create this good, excellent valuation for a European company, but much too small for an American company, is buy companies in America and look for American money and American investors. We'll go into detail, but that has been the general strategy, and that is a problem that you can find in all growing European tech companies. The idea that they are so undervalued as compared to their American equivalents that they have to build another valuation because if the normal European valuation criteria prevail, they will never become a market leader, is general in all 6 interviewed companies. And this creates a vicious circle where European markets value profitability, whereas American markets value growth and a proven business model. And therefore, American markets, American tech companies are valued much more money. European tech companies have much fewer means to make acquisition. Less M&A means less growth, eventually less profit, fewer profits, and therefore even less eventually valuation, and the potential European market leaders end up being bought. This is the generalization from the reasoning from Esker. And so Esker goes west, definitely. It goes looking for American investors in America with American roadshows. You have different strategies for every company. EasyVista has adapted to the European market and gone profitable and has seen its capitalization growth something like 3,000% in 10 years. You have a European strategy, not unlike EasyVista's with Wallix, our 3rd software vendor in our sample. Equinox has gone to 2 private public investors called Aleph Capital and BPI France and raised money to make acquisitions. It has made a remarkable acquisition in 2018, in which Equinox at the time was only 20 million euros in revenues, and it bought a company that had 60 million euros in revenues, and this, of course, made it 4 times as big with a very hard dilution of capital. And now Equinox is about 93 million in turnover for 140 million capitalization, and my memory fails me. It has come, it's in the results it announced last week, it has been profitable for the first time in history. So Equinox is a very strong on acquisitions, actually stronger than Esker, but going profitable as EasyVista and Walix have chosen. Lastly, Gensight Technologies, the biotech, is defying the storm because the French biotechs are incredibly undervalued. We're talking about stacks. A few of them have escaped the French market and go listed on the NASDAQ. And the other ones are facing a crisis that we shall see. Paris has long been known for the vitality of its stock market on biotechs, but there have been no big acquisition of these biotechs as there have been on the Brussels market, for instance. So the companies that are there are suffering and looking for crossover funds to keep growing. And lastly, Actia, the industrial components, they were actually captors and semiconductors for cars and telecoms, uses the stock market mainly as a way to consolidate control of the family. It's a family business owned, family-owned business, and therefore it looks less for an aggressive growth. In a way, it is the typical European company. It is active in 11 countries, and it's more looking for equilibrium than aggressive growth. What do these 6 companies have in common? Well, they all look to or found 4 main solutions to the valuation problem. The liquidity contracts, sponsored research, international roadshow. That would be actually 3 solutions. The 4th solution is there. It's a temptation. It's the listing, but of course they are still listed and none of them has adopted it. Liquidity contracts are an arrangement by which the company pays a financial intermediary to trade in the stock of the company itself. In that way, it creates liquidity, and that is often quite necessary. Actia, for instance, has a daily float of daily volume of 5,000 shares out of 26 million. And the fact that there is so little volume makes for very high volatility. And liquidity contracts guarantee a modicum of volume and therefore make the stock more attractive and a bit less volatile. All 6 companies have liquidity contracts. And the liquidity contractor often provides research as well. But MiFID II has unbundled research from brokerage, and this has had as a consequence a very fast growth in sponsored research. Equinox, for instance, has 5 analysts following the stock, of which only 2 are non-sponsored. I believe it was Esker or Actia. Actia told me that free research has evaporated for small tech in France, and it has become a cost, but not a big one. A sponsored research contract costs between 30,000 and 50,000 euros a piece per year, with a particularity that these are the prices and the use in France. But for international because for American roadshows in particular, you need English or American research, not only for language reasons, because American investors will specifically look after their own researchers. Esquire, therefore, is the one that has most US investors and regularly does US roadshow, but so Equinox has started along the same way, with the idea that for an American investor, a company that is felt to be very expensive in Europe is actually pretty cheap. But this is a very time-consuming strategy, and therefore companies such as Walix or Actia or EasyVista prefer to remain European and look only for German, British, and Dutch investors. And then lastly, you have the strategy of a double listing on NASDAQ, which has allowed, for instance, Genfit, which a French biotech, to raise 240 million euros. But that means that but for that you need a minimum value on the French market. And in the case of biotechs, the valuations have been falling down so far that the window seems to have effectively closed for dual listing, which leaves private equity or trade sales. And the listing is certainly, if not a trend, a temptation. There is a trend for various reasons. The number of software vendors, for instance, listed in Paris has contracted by 60% over 10 years. But the general consensus, moreover, is that private equity would pay twice what public investors would pay on a stock market. And therefore, though nobody would talk about it, the only argument that will make companies stay public is independence. When you are listed, you can keep control with 20 or 30% of capital. It is, for instance, the case of Actia. Selling to a private equity investors and having an LBO'd company means, in effect, for the listed entrepreneurs losing control, and most of them, although they look at it because of the valuations, still seem to be skeptical about it. So this short webinar would not be complete if we did not talk about the common ideal of all 6 entrepreneurs, which is what they call the Nasdaq Européen. Of course, it's not a European Nasdaq, but a single European financial market for tech companies. They agree that the fragmentation of European financial markets is the main reason for the lack of liquidity and research that they have on their own stocks, and the fact that the French market is so deprived of valuation. For the valuation problem, the French market is felt by entrepreneurs to be just too small. And there are very few investors that can treat European technology stocks as a single asset class. Therefore, all 6 entrepreneurs interviewed ask for one market, one single European market that will have the breadth and depth to merit investors, and that will make all European stocks readable by investors. I don't know if there's any questions. I would be very happy to take them. Otherwise, well, that was probably the shortest webinar we made so far. But thank you very much to everybody. Goodbye.